Hello there, everyone, and thank you so much for joining us today. I'm Sam, and I moderate these weekly presentations. And in just a second, we'll be joined by Wesley Boudreau, one of our financial advisors. Wesley is going to be covering some really great strategies that you could potentially use to retire early, such as the post 55 and the 72T strategies. Before he comes on, we're going to wait for just a couple other people to trickle in, though. I'd like to remind you that we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here, so please be reminded of that. Next, I apologize in advance if Wesley does not have time today to answer everyone's questions live. We do get a influx of questions throughout the presentations, and he will answer as many as he can, but I encourage you to still ask away, and I will make sure those questions are fielded to one of our financial advisors to address with you either through phone or email after the presentation has ended. And lastly, while Wesley's speaking, you're going to see some links popping up above his head. Those links will be from me. They're going to guide you to various resources, one of which will be a link to just follow us on YouTube. You can also follow us on LinkedIn, where we post tons of retirement-related content weekly, and we really think you'd get some value out of it if you considered giving us a follow, so please do. And if you choose to do so, thank you so much in advance. We truly appreciate that. And with all of that out of the way now, I think we're ready to get started. I'm going to kick it over to Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said today, we're going to be talking about different ways to access your retirement savings. So we'll be talking about how to get into a potential 401k or an IRA and avoid that 10% penalty if you're under the age of 59 and a half. Doesn't mean we recommend taking money before 59 and a half. It just means that if you do need to get into it, there are some ways to avoid that 10% penalty. We'll go over things like 72T. We'll talk about the age 55 option you have within 401k plans. We'll talk about different kind of one-off solutions and things like that as well. And maybe a combination of some of these approaches. But again, the retirement group, we've spent the last 30 years working with corporate employees and helping them transition into retirement. So we've gone through these in and out, all of our advisors quite extensively. So if you have any questions, reach out, give us a call. We'll be happy to dig into your specific situation. So getting into it, we all hope that we've got some different source of income in retirement, and everybody's a little bit different. I'm not going to suggest that everybody has all four of these on the screen here, but we're going to hope we have some of them at least. First and foremost, we'll have Social Security. I think that's definitely going to be one of the base options where we are going to be getting income coming in on a monthly basis, depending upon when we decide to elect that from Social Security. The question is, how much will we be getting? And that determines it based upon your claiming strategies, which we can go through with you. I know a lot of you may have some concerns about it being there. I don't think we'll have any issues with the solvency of it, but again, there may be risk of potential reductions in the future. We can go through all those different ins and outs in a financial plan as well. Maybe you've got earned income. Maybe you retired and you're getting bored and you're doing something like working at the hardware store or somewhere else just for a little bit extra money. Maybe you're still working. You've maybe switched jobs, but you need a little bit more to get you over that hump. We'll go through that option as well. And then hopefully maybe you've got a pension. Not every company out there has pensions anymore, not that many really. Some of the ones we do work with do have pensions, so we definitely need to monitor and understand those as well. There's definitely some claiming strategies to be aware of there. But that again is a tax-deferred investment vehicle, just like a 401k or an IRA. So that's what we're going to focus on more, your savings and investments. Maybe you've been saving along the way. Most of you hopefully have been saving in your 401k plan where you're getting hopefully some company match depending upon the company, but you're saving on a tax-deferred basis where you're not paying taxes right now. You're getting a tax break as you make those contributions. But eventually over time, as that grows and builds returns, you are going to pay tax when you start taking that money out, unless you've got some after tax in there or Roth, and we'll talk a little bit about that as well. If you've got a brokerage account, that's a little bit different tax treatment. Today we're going to be talking about accessing money from your 401k and or IRAs. So a couple of 401k facts to be aware of, because that's where most people do have a lot of the bulk of their assets nowadays. There's actually about $8.9 trillion in 401k assets. That's obviously going to fluctuate and probably has quite a bit here recently. But just again, let you know, it's a sizable amount of money in there. There's about 625,000 actual different 401k plans out there, and about 60 million active participants within those different plans. So again, it affects a lot of people in America. Right now, about 54% of adults have got a 401k or a 403b plan. And then 19% of Americans have an IRA or a KEO. A KEO is a type of self-employed IRA or self-employed 401k type plan as well. And about 19% of excuse me, about 19% of 401k assets are held in index funds. I apologize. I'm at that age where I have to squint in some cases if I don't have my glasses on me. So again, just for all of us to understand, obviously a 401k is a large aspect of a lot of our retirement savings. So it's important to understand the ins and outs and the taxes associated with accessing that money, especially if you access it early. And when I mean early, that's the age 59 and a half. Another thing to be aware of, and this was something that really kind of floored me too, early withdrawals have accounted for about $6.12 billion in IRS penalties in 2023. So again, that withdrawal is if you take a withdrawal under 59 and a half, there's a 10% penalty potentially. So just do simple math at 10%. That means about $600 billion of early withdrawals were taken out of 401ks over the course of 2023. And looking at what was that, the 8.9 trillion or so, that's probably about 6 or 7% of the 401k assets were removed that year. So again, be very, very cautious and understand this when we get into the details of how to access those money and not be part of that 6.12 billion that the IRS got. Now, some of the different things to be aware of as far as penalty-free access. So again, I mentioned before 59.5. That's the kind of golden rule. The IRS set these up for you, allowing you to defer taxes, but they told you if you take it prior to 59.5 on a normal situation, you're going to pay taxes plus that 10% penalty. After 59.5, there's no penalty. Again, there's still taxes, but no penalty. So that's the one thing that everybody needs to be shooting for. But if not, there's also the age 55 rule, which is, we'll go into a little bit more detail. That's only going to be for 401k plans and employer-sponsored plans where you can access money the year you turn 55 or later. If you left the company, we'll talk about 72T, which is substantial and equal periodic payments. That's an IRS tax code that allows you to take out withdrawals on a steady basis for at least 5 years or until 59.5, whichever is longer, and avoid that 10% penalty, but there's some caveats there. Roth IRA contributions. If you've been making contributions to a Roth IRA over the years, the contributions themselves are going to be still tax-free because it was after-tax money, but the growth on there, if you tapped into that portion, would be taxable and potentially a 10% penalty. And then qualified expenses, we'll go through some different ones, like first-time home purchases, medical expenses, things like that. And then once you hit that RMD age, obviously there's no the required minimum distribution starts at 73, or it could be as late as 75, depending upon your age. There's obviously no penalty associated with that because you're already over 59.5. But the difference there is that's when the IRS comes knocking on the door and says, hey, we need you to start taking money out of your 401k or your IRA so we can start taxing you on it. So again, between age 59.5 and 73 or 75, depending upon your age, that's where we like to do a lot of tax planning to focus on shifting assets from those tax-deferred vehicles potentially over to a Roth IRA so that we can reduce those taxes over the long term for not just yourself, but you and your potential beneficiaries if you're leaving something to family members as well. Now, as far as the Rule 72T, there's a couple different rules on here we'll kind of go through, but very simply put, a 72T is an agreement between you and the IRS based upon IRS calculations of how much you could take out on an ongoing basis for either 5 years or till 59.5, whichever is longer. So let's assume, that you were starting this at 53. Then what would happen is you would actually have to take those distributions for another 6.5 years until 59.5. If you decide to start this at, let's say, age 57, then you would have to take it for 5 years because that's longer than age 59.5. And what happens is you have to stick to that because if you do make a mistake and take out more or less from that specific account, the IRS can come back and actually fine you that 10% penalty retroactively. So let's say somebody set up something that was maybe it was for $20,000 a year for the next 5 years. And they took that out for, let's say, 3 years. So they've taken out $60,000 so far. And then they made a mistake. They took out a little bit extra or they skipped a year. The IRS can come back and penalize them on that $60,000, a 10% penalty of $6,000. So again, be very careful in doing this. And it's very important to work with a company that understands the ins and outs of this and has done these extensively. Now, as far as the breakdown, like I mentioned, it's 59.5 or 5 years, whichever is longer. And the interest rate they use is going to be calculated based upon IRS rates provided for you. Good news is back with the Secure Act in 2020, they bumped those interest rates up where it used to be interest rates were so low, it took a lot of money in order to generate a decent amount of income. Now it doesn't take quite as much. It's tied to the current interest rates or 5%. You can pick and choose whichever is larger, so that 5% really helps out quite a bit. As far as the different methods they use to calculate that out, there's really 3 methods you can use. We can go through this and run it for you, but generally speaking, most people use the amortization method because it creates the highest amount that you can take out. And we'll talk about why that's important in the future, because we don't want to do a 72T on just one account. It's really beneficial to separate your accounts, because if you do it on just one account, then you're kind of handcuffed or pigeonholed into those specific withdrawals, and any little minute mistakes can cost you. So it's better to split an account up and have one with 72T on it and one without, so you can manage some of those potential pitfalls, which we'll talk about in a moment. So the 3 strategies: either the required minimum distribution stretches out of your lifetime, a lower amount; the amortization method usually is going to give you the higher amount; and then the annuity method, again, is a longer term period, so it's going to give you a little bit of a lower amount. So again, we'll run through this with you. We take a look at your date of birth, look at the amount that you're looking to use for that 72T, or we can back into to figure out how much we have to separate from an account in order to generate what you need. So I ran these last week or so, and I ran this. I ran this for somebody about 53 years old. It came out to about 15,000, about 14,000 and change, really, on a $250,000 IRA. So we just rounded this up for illustration purposes. But let's say you're somebody that has a $400,000 IRA, and you come to me and you tell me, Wesley, I need to take money out of there, but I'm only 56 years old, and I know I'm going to get a 10% penalty, and I don't want that penalty, but I need about 15 grand a year in order to pay, let's say, a new car note or pay something, whatever it may be. And so we say, okay, well, instead of taking that out and paying that 10% penalty, if you know you're going to be taking that out for the next 5 years or so, then let's look at doing a 72T. And so we'll take a look at that account and say, okay, well, it only takes about 250 grand at your age to generate that 15,000. Now, again, this is not an investment. It's not telling you this is what you're going to return on the account. It's just telling you this is the amount the IRS is going to make you stick to as far as taking withdrawals. If you go any higher or lower, they'll come back and retroactively penalize you there. Now, as far as the option there, so we might say, okay, let's shave off $250,000, set up a separate IRA, do 72T from that. So now we've got that $150,000 that's still left on the side. We can invest that. You can, if you need something from there, you can tap into it for emergency, but it's not held to the same standards or the same restrictions of that 72T. So you've got that. Now let's assume 2 years come down the road and something happens. Maybe the car breaks down. Maybe there's a repair that needs to be made on the house, and you take out a loan, and maybe you need another $5,000 a month or something like that, or $500 a month or something like that. So we say, okay, instead of taking out a one-time withdrawal, let's go ahead and look at the rates right now, and maybe it takes $100,000 to set up a new 72T for you to go and get that $6 grand a year for the next 5 years without that 10% penalty. So in this case, it shows you how you kind of separate out those accounts, and it's focusing on what do you need for your specific income needs, not just saying a blanket 72T on your entire account. That's one of the biggest mistakes we've seen from people coming to us a little bit after the fact. So some different specific circumstances to look at as well, outside of the 72T or the age 55. Medical bills. If you got medical bills that are over 7.5% of your AGI, that's where you can actually get access to some of this without that 10% penalty. Health insurance premiums, in some cases, if you're unemployed. The death, unfortunately, if you were to pass away, your beneficiaries will get access to that account without that 10% penalty. One caveat to be very, very careful about is if you now have the option of, let's say if your spouse dies, you can roll his or her IRA over into your own, or potentially your own 401k. The problem with that is if you're under 59.5, now you've kind of commingled those assets, so it looks like it's your account, and you may be subject to that 10% penalty again. So again, if you're under 59.5, make sure you keep that separate as an inherited IRA for tax purposes. And then for home buyers, maybe a first-time home purchase that you're looking at, up to $10,000. Also, some secondary education expenses are some other options. Disability, unfortunately, if you get on disability, is another option to look at there. And I sincerely apologize. This is my eyes are going. I need. So there's also an emergency fund option where, unfortunately, if you need access to emergency funds up to the lesser of $1,000, or your vested account balance over $1,000, that's something that came in new after 2023. And then the Disaster Recovery Act gives you up to about $22,000 of potential accessible funds without that 10% penalty. So a couple different options. There's some more than that, but just if you have any questions, give us a call. We'll dig into those for you. Hardship withdrawals, again, this is something that does not negate the 10% penalty. It's just a matter of, will I have access to my 401k? Some 401ks don't give you any withdrawal options until you hit 59 and a half or until you retire. But very, very many of them do have what's called a hardship withdrawal, where if it's for one of about 5 different circumstances, you can tell them and you can get that withdrawal. But again, it still may be susceptible to that 10% penalty. So again, be very careful about that and review those different options there. Excuse me. Let me back up. I think I missed one thing here. Nope, that was it. I apologize on another slide here coming up. So as far as the penalty free, like I mentioned, does not mean tax free. You're still paying the taxes on that. So there are taxation on your withdrawals from your IRAs or your 401ks, because predominantly those are pre-tax vehicles where you've gotten a tax benefit when you put that in. You didn't pay taxes on it. So it's going to grow tax deferred, and eventually you're paying tax on both the cost basis and the earnings. Now, if you made a non-deductible contribution to an IRA or put in after-tax money into your 401k, then that would not be taxable, because again, you already paid tax on that. So the basis would be tax-free, but the growth would be taxable. Just like in a Roth account, if you make contributions to a Roth IRA, those contributions are going to be tax-free because you didn't get a tax deduction on them. But if you're under 59 and a half and it hasn't been there longer than 5 years, then you could have a 10% penalty on the growth. So let's say maybe you start putting in $5,000 a year 4 years ago. So you've put in $20,000, maybe it's grown to $25,000, and you said, hey, I want to take out that 20 grand. You can do that without the penalty. But if you took out the full 25, you'd be paying taxes on that $5,000 of gain and probably a 10% penalty if you're under 59 and a half. So again, be very careful about understanding that. So the rule of 55. This is something that we do a lot of work with our clients because we work with a lot of individuals that retire and leave the company before age 59 and a half. So be very careful if you're retiring at 55, between 55 and 59 and a half, and some advisory firm is telling you, hey, roll everything over to us so we can manage it for you. They're likely looking out for their best interest and not yours. Predominantly, most all 401ks give you what's called an age 55 rule. And what that means is you can take withdrawals from that account if you retire the year you turn 55 or later. So that can even mean retiring in February at 54, but if you turn 55 by December, you're good because it's still the year you turn 55. Now, you are still restricted by the withdrawal options they give you. Some companies may give you one withdrawal per month. Some may only give you one per year. So you need to be very careful about that. Again, that's a way to access that money without the 10% penalty. But again, you still have the taxes on there. There are some limitations on there. Again, keep in mind, it only applies if you've left that company. So it's not just, hey, when I turn 55, I can start taking withdrawals from my account. We've had those calls before. It's once you leave that company. And this is definitely not a reason to leave a company either. So again, if you are trying to review this and have any questions, let us know. And keep in mind, if you're not 55 or 54 yet, you won't have this option. We worked with individuals that have retired at 53. They didn't have this option, so the 72T was the best option. Or even we went out on a limb and worked with them getting a job at another firm so they could roll their 401k over and then wait till 55 and retire there. So there are some different options associated with that. And then there's another option, not saying that we'd advocate this, but you may have a loan at your 401k. Usually they'll let you borrow up to $50,000 or 50% of your balance, whichever's lower. But again, a lot of times there's some ins and outs of that because you are paying yourself interest back, but you're paying that back from after-tax basis, then turning around and getting taxed again later on in life. So we can go through the pros and cons of that as well. But there could be some accessibility there if you need it through the 401k. Now, I mean, ultimately went through kind of a lot of different situations here, but the best way to really kind of dig into it is run a cash flow analysis or a financial plan. Right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 10 minutes with us gathering some basic data, we can run what I call that first draft, if you would, and let you know kind of where you stand. You can say, Wesley, I'm thinking about retiring at 58. Can I do it? We'll go through there and we'll look at your budget, look at everything and tell you, yeah, you can do it, or maybe you might have to work till 62, or you might have to cut your expenses, or maybe if you are looking at retiring at that specific time, maybe it makes sense to work a little bit longer to maximize your pension, or look at some different options in your 401k match. We can go through all those different ins and outs for you. So just give us a call. We'll be happy to kind of go through it and review it with you. Now, the retirement group, again, for those of you that do not know who we are, we've been around for about 30 years. We've got over 150 years of experience across our advisors, and we've actually merged with Wealth Enhancement Group last year, who's got over $100 billion of assets under management and over 100 offices across the nation. So rest assured, if you need to sit down with one of us face-to-face, we can likely accommodate you. Also, most of our advisors will concentrate on a select few companies. So if you've got any specific questions on your company plans, we can probably get into that with you, whether it be going over the pension plan, the 401k, healthcare retiree medical situations, life insurance continuation, all those different items. we can run through that with you. And at the end of the day, it's best to take us up on a cash flow analysis or a financial plan. If you haven't done one, give us a call. If it's been a year or two, then give us a call too, because a lot has changed, both in interest rates and the market as well. So we'll be happy to update those with you as well. So I'm going to wrap it up here, and I saw 2 questions come through that I'll take care of. And if you have any other questions, reach out to us, and we'll be happy to get them as soon as we can. But there's a couple QR codes up here if you'd like to schedule an appointment with myself or one of the other advisors. Or if you'd like to get into our LinkedIn to follow along and get some updated information that way, you can as well. You can reach us at info@theretirementgroup.com. You can also call us at 800-900-5867. Okay, so the questions I got come in here. One is, can I take both an age 55 and a 72 if I need to? It's actually a pretty good question, and it's something that we have dealt with before. I think I mentioned earlier in the webinar that that age 55, you can do it again if you're 55 or older, the year you retire, and your plan allows it. So there are some plans we do work with that only allow you 1 withdrawal per year. So we've run into that situation where we budgeted everything and we left some money in the 401k so they can take that age 55 without the 10% penalty. And maybe they took 30 grand in February. They thought that was going to be all they needed for the rest of the year. Then unfortunately, let's say come August, there's a hurricane or something, or there's some issue that that they need some more money, and they can't go to that 401k and take it because, again, there's only 1 withdrawal per year. They have to wait till the next year. So we've had to go in there and decide, okay, are we going to take it from the IRA as just a one-time, or do we want to stretch this out and do a 72T so we can have that without 10% penalty? And in that case, we're able to do the 72T, get that without the penalty, and then just adjust what they take from the 401k the next year. So again, you can have both options, but it's really important to view those. I would say that the age 55 typically gives you more flexibility, but again, you may or may not have a choice. May or may not have a choice after that. Okay, one other question. If I change my mind, can I pay back the 72T? Okay, this is actually another good question. The answer really is it's yes or no. It really depends upon timing. I would say typically speaking, the answer is no, but you may be able to pay back a part of it. So the only option you would have in there is once that money comes out, you have to stick with that. But the IRS does give you, anytime you take a withdrawal from your account, every rolling years, they give you what's called a 60-day rollover rule, where you can put money back into the account within 60 days. So if you, let's say, had set up a 72T, and you said, hey, Wesley, I'm just going to take out 25 grand a year, and I'm going to take it out every April. And you do that on April, and then all of a sudden you get a new job in May, and you say, I don't need this anymore, and you tell me I want to put that 25,000 back in, then yeah, we can get that back in as long as it's within 60 days. But if you had said, okay, I'm going to take out $2,000 a month for the next 5 years, and we went, let's say we went a year into it, you take out that 24 grand or so, and then you got a job where you said, hey, I don't need this anymore, I don't want to take out as much, I want to save that for taxes. Then the best you could do is just put back 2 months worth. So what's that? $4,000 you could put back in because of 60 days. So you can put some of it back in, but not all of it. So again, hopefully that answers your question. Yes and no, you can do it. But it also may be a point that latter example I gave, only 1 year into it, you might say, well, you know what? Let me put that in and go ahead and just stop it, and I'll pay the taxes, the 10% penalty on the 24 grand I took out already. So I'll pay the 2,400 and not have to worry about being stuck with that for the next 4 years. So again, it's good to review all these different situations. It's good to work with a firm that knows 72T and has run that for multiple accounts, because it's very easy to make those mistakes. And like I said, it is retroactive. In the case of that last one I just gave, if they were taking that 24 a year, let's say they did it 4 years, so that's what, $96,000, and they made a mistake that last year, that's $9,600 the IRS is going to come knocking on the door asking them for. So hopefully that helps most of you with some of the questions you may have. Like I said before, give us a call. We'll be happy to walk through your specific situation. We work with a lot of companies. Does not mean we're endorsed by them or employed by them, but rest assured we can probably give you the information you're looking for. So just reach out, 800-900-5867. Thank you and have a great day.